In 2020, Ryan was named to the Forbes Top 20 Best in State Wealth Advisors for Nevada. Ryan earned his BS in Finance and Economics from Trinity University in San Antonio, Texas, and he went on to complete his graduate work at the Harvard Business School. Ryan has been giving presentations for the UCSD Retirement Association for now over 12 years. He is part of our cadre of what we call our preferred professional providers, who are people that we consider to be the best and the brightest in their field and who give excellent community service presentations to our members. In addition to lecturing to the Retirement Association, he gives regular lectures on Social Security to attorneys and financial advisors all throughout Southern California and the country. And after winter break, Ryan will be back on the fourth Tuesday of each month from 12 to 1 for our Investments Interest Group, which of course is open to all current and retired faculty and staff. Join us each month for a new investment topic. Ryan, welcome. Take it away.
Thank you, Suzanne, and thank you everyone for joining us today. I believe we have Denise running the slides today. So Denise, if we could start with the slide group, we've got a pretty robust group here. Let me start by saying I want to wish everyone out there a happy Thanksgiving, a time to celebrate with our families. So hopefully most of you are down there in San Diego enjoying the beautiful weather. I am up here in the Lake Tahoe area, which is a little cooler, but sunny and lovely. My favorite holiday of the year. My birthday also happens to be on Friday, so 1 year older for me, as well as getting to spend some time with the family. So happy Thanksgiving to everyone, to you as well, Suzanne, and your team as well, and thank you again for having me. This is a very new topic for myself, a new topic. It's a little bit out of the box, if you will, because here we're going to talk about cryptocurrency, which digital assets is what I like to call them, kind of the next wave, if you will, right, of assets or asset classes when we think about client portfolios and we think about different ways to invest. So a couple ground rules here, first of all. As a certified financial planner, I have a fiduciary responsibility when I'm doing presentations like this. So I'm not going to be recommending any stocks or any specific digital assets to invest in. What today's presentation is about giving you the background of the rise of cryptocurrency, where it's come from, give you some of the terms, definitions, and then I want to be very, very clear. I'm not making a recommendation for, against, in any way, shape, or form. This is, again, an educational process. So I encourage anyone and everyone out there, if you have questions, please feel free. I will try to monitor the chat room the best I can. And with that being said, I'm going to go ahead and start with the presentation here, as I actually have to close it down a little bit early today to get to my final meeting prior to the break. So let's go next slide, please, Denise. All right, so I did want to touch real quick, because I think January, and Suzanne, if you want to go ahead and put this in your ledger, we're going to discuss inflation, supply chain, stagflation. And the reason I just put 2-3 slides in here is because I want, the president just spoke a little bit ago as I was in the gym working out. I missed the speech, but was addressing inflation. I think this is something that's near and dear to all of us, because we see it in our everyday lives, right? We see it in gas prices, we see it in food prices, we see it in the turkey we're buying, right? That's potentially $1 or more this year than it was last year, right? So all these different inflationary pressures, definitely in the San Diego area, we're seeing it in housing and rent prices, right? And so what are we seeing as far as inflation is concerned, for those of you that are very concerned about it, because I know it's a word that's being thrown around on all the different news sources. We're seeing a peak here at some point in the next year, and then a retracement on inflation to a normalized about 4% next year, which is significantly higher than we've run for the better part of a decade. I think pause or cause for concern, we could see previous peaks in the rate of change here. If you go back to the graph here and you look back at 2008, I think we all know what happened in the stock or equity markets, as we call them, and then what happened in the general economy when we had a peak of inflation. And that was much more based in the energy side of things. I know energy is a big part of our spending budgets, and it's a reason we're seeing significant inflation wholesale across the board. But we do feel this time is different, and we are going to normalize A lot of this was a supply chain disruption that occurred because of COVID-19 and continues to be disrupted due to COVID-19. Many of you are probably familiar. There's another wave passing through Europe, which of course, disrupts supply chains throughout the world. Okay, so next slide. Just again, this is kind of a preview of my January presentation, but I just wanted to get some end of the year targets out there. If we look next year into 2022, can't believe it's going to be 2022 already. We see GDP growth about 4.5%, inflation 4%. So we still, 0.5% above the inflationary rate, which means we are not at stagflation yet. Still have what we call real growth, which is growth over the rate of inflation. You can see their developed markets, Eurozone, et cetera, et cetera. And our expectation, the S&P 500 next year, which is the largest 500 companies in the United States, should end the year between 5,100 and 5,300. If we look today, I believe it's somewhere in the 4,600, 4,700 range. That's still a very robust rate of return, assuming that you are invested in stocks in the stock market. Next slide. Concern, if there is a concern for next year, you can see here's the top left, fixed income 10-year treasury, 30-year treasury. We're predicting 2 to 2.5% on the 10-year, which right now is sitting in the 1.6 range. That's a pretty significant increase in yield. And just, I always do a bond presentation, but just remember bonds. On one side, you have interest rate. The other side, you have price. And as interest rates go up, bond prices go down. And so, we could have another year where bonds actually have negative returns due to rising interest rates, right? And that's what we see in inflation. We saw today the banks rally significantly, definitely a place you want to be if you do expect interest rates to move up, because banks are the main beneficiaries, banks and energy, of rising interest rates. Okay, so that's more January. So let's now move to the next slide. Let's see what we're going to discuss today. So cryptocurrency and crypto. And so we're going to talk about what is a cryptocurrency. I am going to do a lot of reading of slides just simply because I want to get it right, because I will confess I consider myself an expert in markets and economics, but cryptocurrency, albeit I feel like I have a pretty good handle on it. I am certainly no expert. So if there are experts on here, feel free to message or correct me in the chat if I am wrong. But we're going to discuss what is a cryptocurrency. Again, this is very introductory. For those of you that are very familiar with crypto, this is going to be very rudimentary for you. We'll talk about the different options. We'll talk about blockchain. What is blockchain? Why is blockchain so important in the development of this technology? And then what are the risks and concerns? Why has everybody not adopted cryptocurrency? Why is everybody not piling into it? I would say that there's a considerable, a significant portion of the populace, early adopters, if you will, that are certainly piling into cryptocurrency, but there are significant risks and concerns. And when you think about crypto, and I put down here at the bottom, the future, we can move to the next slide. I want you to think of crypto at like the internet. We're sitting here right now and it's 1993 or 94, right? And the internet is burgeoning and all these companies are coming out with all these fantastic ideas, and we have these computers now. I went off to college in 1995. I left high school, graduated high school in Dallas, Texas in 1995, and I went off to college at Trinity University. And I still remember going to the library and, pulling up articles, that we had a search that you could search different articles, and you have to go pull the book or the paper or whatever. And by the time I left college in 2000, this whole search engine, Google, all these different types of search engines were around, and essentially the entire landscape changed. But we also have to remember that there were the pets.coms of the world, or the WorldComs, all of these different companies that had these massive, incredible valuations that no longer exist, or even companies that exist today, but their valuations are nowhere near what they were back in 99, 2000. And that is probably, going back to risks and concerns, is where are we in the digital world or the digital asset world? It's not just a question of this is a new technology and I should adopt it as soon as I can. I need to adopt it at the right price. And that's the big question, because there are going to be many digital currencies that will probably no longer with us in 10, 15 years, similar to the fact in the late 90s, there were many dot-com companies that no longer existed. So I will say, as a rule of thumb, when we talk to our investors or our clients, when it comes to digital currencies, and look, someone can tell me all day long that the last decade, cryptocurrency outperformed every other asset class. I get it, right? But that's looking back. It's really easy to look back and find all the performance, right? It's really difficult to look at the next 10 years. And so I caution everyone out there, as I do my clients, and we use a rule of thumb, 10% of a portfolio, maybe if you're in retirement, maybe even less, because cryptocurrency is very, very volatile. We'll go over some of those numbers here in a second. So let's move to the next slide. So let's go over a couple definitions because I think it's important. Previous slide, please. Thank you. So let's look at a couple definitions when it comes to cryptocurrency. I think it's really important to understand exactly what we're talking about. So crypto, as we call it, or cryptocurrency, comes from the word cryptography, which just means the art of secret codes, right? And when I say secret, not the secret that you're passing around the table, not something that's, encrypted in a secure email. I'm talking like military grade security. And we'll go over exactly what that looks like. There's something called a digital wallet. So even though if you turn on CNBC, you go to Coinbase.com or whatever, and you see the B, with the gold coin, there are no gold coins for Bitcoin. There are no coins that exist whatsoever, right? Bitcoin and all the cryptocurrencies are all digital, right? So the only way, obviously, to access them is through a digital mechanism, right? So, whether it's a smartphone or a computer or whatever it happens to be, a tablet. And then private key, which is the personal code, usually 50 digits long, 50 to 60 digits long, and a chance of guessing someone's crypto private key is equivalent to winning the lottery 9 times in a row. And I think that's important to understand how secure cryptocurrencies are, right? And how, quote unquote, safe they are. When I say safe, I mean someone actually breaking into your digital wallet. Next slide. So cryptocurrencies, let's just talk about the genesis real quick. There was a paper published in 2009 by a gentleman or gentlewoman, we're not sure, because of using a pseudonym, Satoshi Nakamoto in 2009. They're not physically minted or printed. Like I said, it's not like a $20 bill or a dime or a penny or $100 bill. They're all digital, as I said before, right? So you have to access via smartphone, tablet, computer. The first cryptocurrency was Bitcoin, launched in 2009. And this person, this pseudonym, Satoshi Nakamoto, is credited with the actual creation of cryptocurrency. There's been speculation that it was actually Elon Musk, using the pseudonym like a William Shakespeare or a Mark Twain type of thing. But it has yet to be proven who the actual progenitor is of cryptocurrency. And it doesn't really matter, probably not. So when you say digital currency, is this the same thing as me paying with my credit card, my Visa, my MasterCard? No, not at all. Right? When individuals use a credit card, you're actually paying a U.S. bill, but you're using U.S. dollars and you're using the U.S. money and banking system, right? That's not the case when you're using crypto, right? You're using a decentralized system, not a centralized system. Next slide. We'll go into that a little bit more here in a second. So how are cryptocurrencies different than traditional money, like just using the U.S. dollar, right? So first of all, and a lot of people don't know this, like when you talk about the money supply in our country or the amount of actual currency that's circulating out there, physical dollars, $100 bills, 20s ones, is only about 16% of what is circulating in the U.S. economy, right? So think about that. So that means if only 16%, that means 84% of the dollars that are circulating are actually digital. They're held in your bank accounts. They're held in your investment accounts. They're held, whatever they're held in. But it's actually not a physical dollar or $100 bill that is backing it, right? We got rid of the gold standard back in the 60s, I believe, early 70s. And so there's only 16% of US dollars circulating are actual physical dollars, all right? So the 3 main differences between traditional money like the dollar and cryptocurrencies are 1, how they're used, 2, how they're created and more importantly controlled, and 3, how they're secured. So let's go to the first, how they're used. Traditional money is both electronic and physical, right? Like I can go down to the casino. I'm up here in Tahoe. I go down to the casino and I can put $100 bills in the machine, right? Or maybe I have a player's card and I have credit on that and I can use that player's card. Or you go to the bank, you can make a withdrawal, right? And you get actual physical currency or cash. Or I can send a wire transfer or an ACH. And do you actually send hundreds of dollars of bills to whoever? No. I would bet that most of you out there, if not all of you, pay the majority of your bills electronically. You're not actually paying in cash. Oh, well, I write a check. It's still a check. It's not actual physical currency, right? So cryptocurrency exists electronically only. There's actually no physical transfer whatsoever of a currency, right? Now, the second part, created and controlled. How are they created and controlled? Well, traditional money, so we have central banks. Yesterday, the president announced he's renominating Jerome Powell to the Fed. You may have heard of all that. So we have a central bank in this country called the Federal Reserve, and that central bank determines what's called monetary policy. And then we have the legislative branch, which determines fiscal policy. And those two policies together determine many, many things in the economy you're not being aware of, like interest rates. And interest rates predicate pretty much everything from a money standpoint in the world. I mean, think about it. Interest rates determine mortgage rates. Interest rates determine the rate of return that investors want on stocks and bonds, right? It determines your CDs. I mean, I can keep on going on and on and on, but that central control is what is unique to traditional money, whereas cryptocurrencies are created outside of government-led money systems and uses a unique set of technologies which create, track, and control the rules surrounding the currency. So cryptocurrency resides on a global network of computers accessible to anyone. And this is a very decentralized system. And this is also why many central governments are very concerned. You may have seen that China banned any form of cryptocurrency, which sent cryptocurrency spiraling down 50, 60% recently. And I think you're probably going to see that from several more central banks because countries or governments want to have control over the money supply. And cryptocurrency is a way around that, right? Does that mean it's bad or it's used for illegal enterprises? Not necessarily. It just means it's different, right? It's a new technology, similar to how the internet was a very new technology for us back in the 90s. In the 90s, did you ever imagine a day when you wouldn't be going to sit in the bank line and going to the teller and making your check deposit, withdrawing money, et cetera, et cetera? Nowadays, you pick up this little thing, right? And you make a deposit. You send somebody a Venmo. When I go play golf, Ryan, money represents the value of capital labor. Where did the initial value of crypto? So, good question. Let me continue on. I'll get to that because that's a very difficult one. But we can transfer money right here, right? So digital. And this is something that certainly didn't happen in the 80s and 90s. Okay. So and then security. Traditional money, centralized governments. Have money systems secured, locking out potential bad actors, right? So when we think of the short-term interest rates that the Federal Reserve can influence, to what's called the Fed funds rate, right? That's only accessible by our banking system here in the United States, right? You and I, as individual investors, we can't go to the Federal Reserve and borrow from them, right? And so they are able to lock people out, whereas cryptocurrency is very decentralized and secured by investing everyone into checking on everyone else because they trust that there's no single authority. All right, so next slide, please. Denise, next slide, please. So again, just going back to who the founder is, and I just pulled this right off of Wikipedia, but Satoshi Nakamoto's name used, presumably a pseudonym, who developed Bitcoin, authored the Bitcoin white paper, created, developed Bitcoin's original reference implementation as part of the implementation, also devised the first blockchain database, which is, I think, what you think of as a ledger, right? And was active in the development of it until December 2010. And again, it's big mystery who the real person is or persons behind this pseudonym, but I thought I'd at least include this. And if you want to read more about it, obviously just go to Wikipedia and click on a couple of the links. Next slide. All right, so again, in graphical form, what is the difference between traditional money and cryptocurrency? Because I think this is very important. On the left, we have traditional money. It's physical or digital, transferred through financial institutions or financial intermediaries, Venmo, PayPal, JP Morgan, et cetera, and cryptocurrencies, all digital, transferred from you to me, you to your friend to whomever, no financial intermediary, right? So is this a risk for banks? Obviously. Government institutions, again, what's the difference? The control, Federal Reserve, Treasury, regulators, financial institutions. And then on the crypto side, it's blockchain technology. It's a ledger that's viewed by anyone and everyone out there in the world, okay? So there's no central government organizing and regulating all the different intermediaries. Again, on the left side, security, centralized money system, government control, regulated. On the crypto side, there's no government regulation except for in China, and it's community checked. So everyone is essentially in it together, checking on everyone else. Next slide. So how many cryptocurrencies are there? And again, this is where I think the parallels to the dot-com bubble are very apparent, right? And the rise of the internet. Today, there are more than 9,000 cryptocurrencies. Is it fair to say that a large portion of those will fail, or the efficacy of them for long term is bleak? I would say yes. Market capitalization in the industry has grown from 0 in 2009 to 1.3 trillion today. If you think about the U.S. economy, GDP of the U.S. economy is roughly 20 trillion per year. So the Bitcoin market value or market capitalization is roughly 1/20th or 2/20, you can say 1/10, I guess, of the U.S. economy. So it has grown substantially. And that's why you have a bunch of people out there that are extremely wealthy because they were early Bitcoin, Litecoin, Ethereum, whatever they were, investors, okay? And so Bitcoin is currently the far largest by 600 billion. It accounts 45, just depending on who you ask, between 45 and 50% of the industry. Next slide. And, you know, again, as with any investment, when you start to hear about these massive outsized returns, you get massive growth in anything. Again, parallels to the dot-com bubble, right? You get a lot of buzz, you get a lot of, you know, different things, you get a lot of chasing of returns, right? But I think the really interesting about cryptocurrency, and again, seeing the parallels back to the 1990s and the internet, is that there's so many applications outside of currency transfer or money transfer, right? Literally, blockchain technology could have applications, and we'll talk about them here in a bit, in art, in stocks, in insurance, and land titles, voting, all types of different potential applications if the technology can really be massaged to fit into the different parts that, you know, require regulation and government control and all that stuff. So it's very interesting to look at the development and watch the development. It's also very hard to parse out where to put your money or invest it. Next slide, please. So, you know, again, can you explain what the technology does? And, you know, and I wanted to put the slide, I know most of you can't read it, but this is also being videotaped, so I wanted to have the slide up there. And essentially just going to read it because I think it's really important, and it says it a lot better than I can tell you, right? So the basic platform is designed to store and transact digital data or digital value, right? It's unique in that the computer code and strictly enforces a rule which cuts out human judgment. Technology platform is open and transparent, yet has secure and private, right? The 4 key ingredients. Again, 4 key ingredients to crypto, right? Cryptocurrencies, blockchains, cryptography, and decentralization, okay? You know, a place where digital value is created called a cryptocurrency. The cryptocurrency is stored on a digital ledger. Again, we talked about that, called a blockchain. All cryptocurrency transactions are tracked, stored, and fused inside the blockchain. And remember, anyone can go look at those at any time, right? Removing a transaction from a blockchain can be exceedingly difficult, which has made fraudulently obtaining currency similarly difficult, right? So there's a layer of protection in that. Another important safety feature is the blockchain is open for anyone interested to see and scrutinize, right? So you have, again, the community able to look into it, right? And basically self-police or self-regulate. A third key security feature, the platform has been that most blockchains are decentralized. We'll discuss that as well. Fourth, individual privacy is protecting using cryptography. And as I said earlier, the level of security, right, to break into someone's key code is nearly impossible. I don't want to say impossible, nearly impossible. And lastly, how they're designed, ultimately value, can help secure the platform too, right? The more valuable the cryptocurrency, the more participants want to join and regulate, right? So you have more of the community coming in. Next slide. And so again, I wanted to make sure that we had a, you know, a slide here that you can go back and look at, since it's being published on the UCSD website, on exactly how blockchain works. So if you start on the left over there, 1, a user initiates a transaction process. To the process or the request is broadcast to a vast network of thousands of computers called nodes. The nodes then produce algorithms to validate the user's status and transaction. Once validated, it's added to the ledger, and then the transaction is complete and out there for anybody to see. Again, it doesn't say Ryan Hyslop out there. It would be my digital key or code, right? And so, but the transaction is out there, again, for the world to see, right? And the ledger is fully transparent. There's no printing of money. There's no, you know, transaction is completely encrypted. It's decentralized, and it can be improved at any point along the way. And it's, again, viewed in a decentralized manner by the entire community. Next slide. So what are the things that we should fear, or the risks that are inherent in a new technology like this, right? Next slide. So there was this study done by Bloomberg last October, right? And they surveyed 500 ultra high net worth investors on crypto investing and asked them what were their main fears about investing in crypto. Next slide. So number one was, well, it's not regulated, right? So I have no, I may not have faith in the community, right? Because I'm so used to government regulating everything or being the final arbiter or protector of, my assets. And this fear is understandable because, again, it's a new technology, right? Do we believe that the fear may be overly unwarranted? Possibly, right? There has been fraud, obviously, within cryptocurrencies. We'll discuss that in a second, right? And additional regulation can mean a clearer regulatory path, which is likely a key reasons institutional interest grew in 2020, right? And a lot of institutional investors are moving into the space to put investment dollars as well. Next slide. So another reason we may be worried about it, right? The volatility. And I think this, especially for investors that are at or near retirement and looking at, a distribution strategy whereby they're going to be living off of their portfolios in retirement. The amount of volatility in cryptocurrencies, particularly some of the less mainstream cryptocurrencies, is eye-watering to say the least. Very similar to the volatility in tech stocks as we went into March of 2000 and the dot-com bubble burst. And you literally had companies like Lucent Technologies, right? Many of you have heard of that. That was, by the way, one of the top 10 companies by market capitalization in March of 2000. And subsequently, they lost 92% of their value over the next 2 years. That's not an investment that you can tolerate if you're a retiree, unless it's money that you're not going to touch. Because if you're drawing assets out of your retirement and it loses 80% value, which Bitcoin itself has done 5 times since 2010, 80% of its value has been lost and then recaptured, right? But if you're using that as retirement income, I would argue that puts you at significant risk of running out of money because you're going to still need that money or that paycheck to live on in retirement, right? So again, this is why, as I go back to the very beginning of the presentation, and I say 5-10% allocation of your portfolio to something like this, especially if you're in the retirement, should be a maximum, not a minimum, right? And certainly people out there would argue with me and say that I'm wrong on that. In the last 10 years, the performance speaks for itself, but I caution you, last 10 years doesn't mean the next 10 years. Similar to dot-com from 90 to 2000, the next 10 years did not produce the same results, right? Next slide. What's another reason? Well, there's still a high potential for fraud. Over the 9,000 plus cryptocurrencies in existence, a high percentage of them will probably fail, maybe from fraud scams. Many of you maybe have heard of Dogecoin, D-O-G-E, right? Which is not even a cryptocurrency, right? It was made as a joke, right? And it had this astronomical valuation, but there's essentially no value to it whatsoever, right? You just hope that you're selling it to the next greater fool, right? So again, I think you have to be very careful and you have to understand what you're investing in, and you need to be very well versed in what you're, not just, what's going to happen in the next month or 2 months, but, if you're going to put money into it, you have to be willing to accept those big drawdowns, and you have to be able to understand what the long-term efficacy of that particular currency is. Next slide. So, again, this is why we're doing a presentation like this. A lot of people just don't know enough about it, and including myself, right? I'm 100% honest with my clients, and I say, from my standpoint, I know ways if you want exposure to cryptocurrency. My favorite's probably using Coinbase, which is, had an initial public offering earlier this year on the exchanges, I believe either NASDAQ or New York Stock Exchange. Anyhow, that's certainly one way to get exposure to it without putting money directly into one of the cryptocurrencies. You're investing in the exchange. But there's also some ETFs now that are out there that I certainly would not invest in. I think BITC is one of them, and that's that invests in futures, which carries so many more risks other than just the actual movement of the underlying price of cryptocurrency, because it's trading futures. So again, it's important to understand and to be knowledgeable about what you're investing in, and make sure you understand how the potential price movements would move with the underlying cryptocurrency. Next slide. there's, again, the risk of a specific cryptocurrency no longer exists. Any cryptocurrency that goes to zero, if you're invested in it, that could mute any returns you have in another cryptocurrency that goes through the roof, right? So it's very, very, very risky from that standpoint. Next slide. And then finally, the last one is, of course, we're always worried, especially a technology that we're not super familiar with, that we're not as comfortable with other ones, is there's a hacking risk. Well, I would argue there's a hacking risk in almost everything we do, right? And not all hacks are created equal, right? In 2020 alone, there were more than 120 reported attacks on cryptocurrency. And most hacks are not happening in the blockchain themselves, which is critical to survival of the industry. Many thefts are due to users not securing their digital wallets properly, right? So that's more on the user than it is the actual efficacy of the currency. Next slide. So again, just to look at it graphically, top reasons not to invest in cryptocurrencies, according to 500 high net worth investors in the Bloomberg research survey: not a regulated market, volatility, fraud, just don't know enough about it, the risk of a cryptocurrency no longer existing, and the hacking risk. Next slide. So, the next two slides, I'll just kind of skip here real quickly, but, then there's also, I think, this unsaid thing about cryptocurrency, which there are a significant amount of illegal transactions on the blockchain, right? They are used by, criminal enterprises such as drug cartels, maybe human trafficking cartels, et cetera, et cetera. And I think, that is a significant risk, certainly within cryptocurrency, because it is so good at protecting who's actually transferring the money. Next slide. But the reality of it is, so just the recent example, the Colonial Pipeline hack, they requested payment in cryptocurrency, but they were able to track down who actually was requesting the payment. So, I guess that was a good thing, right? So illegal activity only represented about 2.1% or 21.4 billion of all cryptocurrency transactions in 2019, right? And less than 0.3 or 0.34% in 2020. So I think this part, if this is a concern of yours with investing in cryptocurrency, I think this is certainly something that has been identified as being dealt with as cryptocurrency matures into a more mainstream technology. Next slide. So so we looked at the risks and concerns. Let's look real quick at a couple of the cases for investment. So a cautionary tale, next slide here, real quick. Direct investing in cryptocurrency can be appropriate for certain investors, but again, Bitcoin has had 5 crashes of 80% or more since 2009. So be aware of that. That being said, again, since 2009, it's the best performing asset class across the board, not even close. And there's an argument to be made that there's a lot less investment in precious metals like gold as a hedge towards markets or to markets like stocks and bonds as a diversifier, because people are using crypto as a diversifier in place of gold. Next slide. So again, just looking at the digital evolution, if we go back to 1995, only 1% of the world, the global population, was using the internet. By the time 2000 rolled around, 7% of us were, and by the time 2010, roughly 30%, and by the time 2017 rolls around, 50% of the world is using the internet on a daily basis, right? It could very easily see how cryptocurrency would have a similar type of trajectory, right? So again, looking back on the internet, the rise of the internet as a guide to what cryptocurrency looks like, right? We are only, 11, 12 years into the cryptocurrency movement, right? So there is still potentially a significant amount of growth to come out of the industry. Next slide. And one of the things people love about cryptocurrency, just again, odds of a coin flip guessing heads or tails, 1 in 2, right? Odds of guessing the correct number in roulette, 1 in 32. Being dealt a royal flush, which I did get on Sunday at dinner, 524,288, right? So pretty rare odds. Winning Powerball, Mega Millions on the same day. I don't even want to try to read that number. Guessing the NCAA March Madness bracket. And you go down at the bottom, guessing a random Bitcoin private key. That's a pretty small risk, right? So I think it's important to understand how secure blockchain and the network are. Next slide. So again, what are two very, very attractive features of cryptocurrency? One is this next level of security, right? And again, you can come back and read the slide if you want on the replay. Next slide. And Second is, again, this power to the people, right? The decentralization effect. Everybody watching the blockchain ledger and keeping track of not only its efficacy, but its its security and all the transactions that happen on the blockchain. Next slide. So in the real world, what are some applications we could see moving forward? Next slide. Now I'm going to kind of run through these because I do have to wrap this up in the next 5 to 10 minutes. But art, music, and entertainment, right? Cryptocurrencies offer artists a new, more artist-friendly business model. They can go directly to fans directly to artists, cutting out many third parties, right? Cutting out the Sotheby's of the world, right? A recent example from a popular rock band, it released a special, more expansive version of its new album as a cryptocurrency. And maybe some of you have heard of these things called NFTs, non-fungible tokens. I didn't include it as part of the presentation, but I would encourage you to go read about NFTs online if you have some time later today or over the holiday. So the fans who brought this album cryptocurrency form gained access to unique experiences, spending time with the band, lifetime front row tickets, et cetera, right? So here's one application. Next slide. How about in the world of healthcare, right? Gives patients the ability to securely move and store their medical records all from their personal digital devices. We've heard over and over again, right, that data, these companies like Facebook, right? They sell your data. Google sells your search data, right? Data. So what cryptocurrency and blockchain do is allow you to bypass the Facebooks of the world and not allow them to sell your data. You take control of the data. Next slide. So where's another place, right? How about real estate, right? And the transfer of titles, right? Transferring of deeds and titles into blockchain to remove the need for physical copies, streamline the title-related activities. Access can be strictly limited to property owners, while third parties, example, cities, states, banks, can access the data as permission. You give them permission to. So again, and on the financing side, certainly, right? Multiple projects are underway to help make it easier to invest and divest of real estate holdings. A house seller, as an example, could sell a home to 4 different investors, not just one buyer. Again, just some of the potential applications, all new, certainly not developed as, but going back to the internet again, there's many things that we started off, AOL, all these other things that are no longer really with us as the internet continues to develop. And I think you'll see the same thing in cryptocurrency. Next slide. Another application here, and finally, cities and states, private companies developing projects. The state of Illinois has started the Illinois Blockchain Initiative, which aims to use blockchain to enhance security around social security numbers, birth certificates, voter registration cards. So another application. Next slide. And so pretty much anything, this is what's called our digital footprint, right? Email, music and video downloads, financial records, home security, social media, health records, website browsing. It allows you to potentially encrypt all of that away from the Facebooks, the Googles, et cetera, right? And so that you take control of your own data or privacy through all these different mediums. Next slide. Obviously protecting personal data, we've talked about that. Next slide. So bottom line here, cryptocurrencies are the next digital era. They really are the next technology that will rise. I think it's very important. How do cryptocurrencies pay for their large? Okay, so Doug, I'll get to questions here in a second. Cryptocurrencies can play an important role in our next digital era as the underlying technology specializes in data security. What does it mean for investors? Again, the role of cryptocurrency in supporting digital ways of doing business really reinforces our view that cryptocurrencies have become viable investments. Next slide. So how do we view it? View it as a set of technologies that will shape the next digital era. Do I have any idea how it's going to end up, what the winners and losers are going to be? Absolutely not, right? I think anyone that claims that they do, it's probably just like the people that told you that they were making money hand over foot on the internet era. And then when that bubble burst, they ended up losing 90, 95, maybe 100% of their investment, right? So I think it's very important if you're going to invest in this technology, right, to not go all in or make it, and you'll always hear about the people that became wealthy off of their, cryptocurrency investments. I would highly encourage you, if you are going to go into this space, please make it a portion of your portfolio that you can lose the whole thing, or it'd be great if it doubles or triples or 10x, whatever it happens to be. Next slide. All right, we're in my slides. So I'm going to go into chat, and to be 100% honest, some of these questions are pretty difficult. And as I said in the beginning, this is more of a primer. And I don't want to BS anyone on here. I want to make sure I answer questions I know. So first from Suzanne Chaffee, money represents the value of capital and labor. Yeah, it's just also storage of value, right? So it's not always capital and labor, right? We do have money that, we save that is not necessarily capital or labor. Maybe we inherited it. Where did the initial value of cryptocurrency come from? That's a great question. I would refer you to the paper the Nakamoto paper from 2009. That would be the best place to actually, because I've skimmed it. I've not read the whole thing, but my understanding is in there is a pretty good explanation of exactly how the value is derived from cryptocurrency. So second from Doug Richmond, Ryan, how do cryptos pay for their large energy costs? So I think what Doug's talking about here is mining, cryptocurrencies, mining Bitcoin requires an incredible amount of energy to, cool supercomputers, all these other things. How do they pay for the large energy costs? Well, I would assume they pay for them by, the cryptocurrencies that they're mining, right? And then how are they subject to income taxes? That's a great question too. So the rise of income tax, you may have noticed in the last 3 or 4 years when you fill out your income tax planner for your CPA, it says, have you made any cryptocurrency transactions, et cetera, et cetera. So the IRS caught on to this 3-4 years ago, and they certainly, they want to make sure they're taxing your cryptocurrency. So how is it subject to income taxes? It's my understanding is it's subject similar to a commodity at this point, right? And so, you're subject to the, all the rules of any other assets that you hold, long-term capital gains, short-term capital gains, et cetera. But I would refer that to your CPA for an exact explanation. Can you please explain the mechanism for converting cryptocurrencies to and from hard currencies like USDs? Yeah, so, there's a lot of, so the majority of that happens on these different exchanges, right? Just like a broker dealer converts your stock into cash or cash into stock, there's, commission, that's what a Coinbase does for you, right? There are now ATMs out there in which you can go and pay. And of course, you're going to pay a fee and you exchange your Bitcoin or your Ethereum or your Litecoin into hard currency, right? And that's just essentially the exact same concept as you're trading your Apple stock for cash, right? Except for they're taking the risk of the Bitcoin. One of the interesting things now, does the IRS monitor the money earned or wealth? Is just another way of avoiding taxes. I don't think it's certainly a way of avoiding taxes any longer. The IRS certainly knows that there's a ton of wealth out there in Bitcoin holdings, not just Bitcoin and cryptocurrency holdings. And I think they're very clear that they are not going to allow cryptocurrencies to avoid IRS tax regulations. So it is 12:45. I want to open it up. We can take the presentation down now. I'm done with the presentation. And again, I want to thank each and every one of you for coming in here for this presentation. This is my first time ever doing one on cryptocurrency. And I'm sure there are probably people here in the presentation that may be better experts than I am. And I encourage you to get into the chat. Maybe you can answer some of these questions along with myself. This is kind of like the blockchain. We're all here as a community and we can answer each other's questions.
I'm just really curious about where the value comes from. I mean, could I just say, okay, hey, I'm going to go out and create a new cryptocurrency, and I'm going to have 1,000, what are they, shares or pieces, and each piece is worth $1,000. Ryan, do you want to buy 10?
Isn't that exactly what happened in Dogecoin, right? It was made as a joke with a dog on it, and again, there's a saying, it's the same thing with stock, right? You can have a stock that has no value. Like the underlying company is not making any money. Let's take some of these, electrical car companies, not Tesla, but some of them that have never even created a product. They have a theory, right? Of how they're going to go about doing it. And people are paying, whatever for that stock price, but how do you value that? That's just pure speculation, right? And so again, who's the greater fool? If somebody's willing to buy something from you at a higher price, right, then it has value.
Okay, legit. Members, anybody else have a
Probably
question?
not the perfect answer you're looking for, but yeah.
Everybody's
well, if I have no more questions. Yeah, sure. I'm sure.
Go. We know you have another meeting. Thank you very much. It was a great presentation, a great primer, and we'll take it all from there and do more research. But thanks very much for introducing the topic for us.
Yes, thank you to everyone. And again, I want to wish everyone a wonderful holiday. Happy Thanksgiving. Be safe out there and enjoy your holiday.